A dramatic sell-off hit Wall Street on Friday, bringing a sudden end to a 2-month rally. The tech-heavy Nasdaq composite suffered its largest single-day point drop in history, plunging more than 1,121 points. At the same time, the Standard & Poor's 500 index saw a staggering $1.8 trillion wipeout. Analysts say the sudden drop came as investors reacted to rising bond yields and renewed worries over inflation, forcing many to rethink their high-flying technology bets. It is a stark reminder of how quickly market sentiment can shift. The Federal Reserve may not be done raising interest rates just yet. Diane Swonk, the chief economist at KPMG, warns that persistent inflation in the service sector and a resilient labor market are driving a more aggressive stance among central bank officials. Swonk points out that bond market pricing now reflects growing expectations for a 25 basis point rate hike in 2026. This represents a significant shift in the monetary policy outlook as investors prepare for borrowing costs to remain higher for longer in order to cool down the economy. A surprisingly strong jobs report out of the United States is easing fears of an upcoming recession. Gene Sperling, the former director of the National Economic Council, says the latest hiring numbers are highly encouraging, showing broad-based strength across the economy. However, Sperling notes some of these gains may be temporary. For instance, a surge of 70,000 new hospitality jobs could be driven by seasonal hiring ahead of the World Cup. Even though wage growth is still lagging behind inflation, the robust headline figures suggest the economy remains on solid ground for now.